Hi everybody, welcome to the Leeb's marketforecast.com video for March 20th, 2013. Over the weekend, the European crisis again stepped into the spotlight. The small island nation of Cyprus was expected to get 10 billion euros in bailout money, but surprisingly, the IMF and the ECB, headed by Germany, the EU's effective paymaster, demanded that the Cypriot people foot a significant part of the bill. Because Cyprus has not issued many government bonds, it was not enough to force bondholders to take steep haircuts, as in the case of the Greek debt swap from last year. Instead, the burden fell on the shoulders of the country's private bank depositors. Not surprisingly, the Cypriot people, as well as Cyprus's many foreign depositors, did not appreciate the idea of losing a good chunk of their savings. In anticipation of bank runs, Cyprus had to temporarily close down its banks, but ATMs were soon running short of cash. Although the proposal was later watered down when it was brought up to a vote, the Cypriot parliament, in effect, unanimously rejected the proposal yesterday, leaving the status of the bailout in limbo. The risk of contagion here is very real. Specifically, the unprecedented confiscation of private savings could spark bank runs in vulnerable countries like Spain and Italy, whose economies are much larger. And if the Cypriot banking system were to collapse, the country may have to exit the Eurozone with unclear consequences for the rest of the Euro bloc. Basically, there's never been an exit from the Eurozone before, and there's currently no legal mechanism in place to address such a scenario, so the size of the fallout could be potentially quite sizable. Now, fortunately, so far, there has been no mass bank withdrawals in other countries outside of Cyprus. Even if Cyprus were to fail to get additional money from the IMF and the ECB, it could very well still get a lifeline from Russia, the largest foreign depositor on Cyprus. About a year ago, Russia already loaned to Cyprus 2.5 billion euros at well below market rates. So this time around, very well could reopen its wallets in order to protect its interests on the island nation. Despite an initial drop, the reaction in the stock market here in the US has been quite subdued so far, especially considering that conditions were ripe for some profit-taking anyway. That suggests that despite the initial shock to the Cyprus development, market participants do not expect a disaster here. Nevertheless, we think that the situation still warrants very close monitoring because the potential for deterioration is there. And also today, the Fed's FOMC concluded its latest policy-setting meeting. And as expected, the Fed did not rock the boat. Everything status quo pretty much remained, particularly considering that the recent developments with Cyprus, the Fed simply cannot afford to begin to withdraw a monetary stimulus or even give a strong hint of such action. That's for today. Thank you for watching.